Stocks softer as we start this Friday trading session, but we've also got fresh views on the economy, data from both Canada and the United States on the jobs front. Let's bring in Chhad Aul, who is Chief Investment Officer of Sun Life's SLGI Asset Management, for some more perspective. Chhad, let's start with the Canadian job story, if you don't mind. We're trying to make sense of it in our newsroom today. 2 straight months of weaker job losses. Is it a sign that the labor market was already just too tight? Or is it a reminder that as the Bank of Canada ratchets up interest rates and the worries about a cool down of the economy take hold, that this is what happens, that jobs start to deteriorate?
I think it's really pointing to continued tightness ultimately, right? We're seeing participation rate really is what's dropped in the last couple of months, really in line ultimately with those jobs that were destroyed. So the story continues to be, an ultra low unemployment rate, no tick higher in unemployment, and ultimately, we still have vacancy rates at very high levels. So what matters for markets, policymakers, et cetera, is the tightness of the job market, and you're not seeing any signs of slack there whatsoever at this point.
Well, then let's dig right into market strategy, because if the takeaway from a Canadian jobs report, even if there are job losses, is that the unemployment rate is still quite low on a day when the U.S. report showed job creation, and immediately people said, okay, well, the Fed can continue on their hiking path. We had a conversation earlier in the program about what that's going to mean for interest rate sensitive stocks. And I wonder if it's a here we go again, Chhad, because I was just looking at the performance of, as we look at the Canadian dollar as well, I was looking at the TSX since its July lows. It's had a nice bounce. We've seen tech stocks, even companies that continue to come out with cautious news, that have done relatively well. Shopify, I think, has surged about 30% over that period. The NASDAQ 100 since its June lows has rallied about 20%. You got Tesla, Amazon, Netflix. They've all had these really sizable advances, and people were trying to say, what gives there? Is there some air? Are there some air pockets in those advances?
I think there is. Ultimately, the moves of the last couple of weeks, which really ramped up, I think, with the Fed meeting last week, and the market's interpretation that there was a dovish pivot mixed into the commentary there. We were very skeptical of that interpretation and much of this, this market bounce that we've seen. In fact, we've been using that to further de-risk and get the portfolio into more of a defensive orientation. But you're right, an absolute blockbuster jobs report in the U.S. No nuance there, unlike the Canadian number, points to continued tightness in the labor market, and we think really points to continued hawkishness coming from the central banks. And this fight against inflation, ultimately, we're not there yet. We're not at the point where you can begin to price in this sort of pivot, which of course is going to be supportive for many of those areas and many of those stocks that you mentioned that have been the most beaten up so far this year.
Okay, and let me really put you to work here on a Friday with energy. We've talked already today about standout results from a lot of different players, right? They're swimming in cash because oil prices had been so strong. Now we have seen oil prices cooling very quickly because of the broader concerns about demand if the economy is cooling down. Now, the valuations on Canadian energy stocks, even after the run-up we had previously seen, still look pretty good compared to a lot of stuff in the market. And remember, there was that argument. Some people said, well, if you're worried about inflation, you could maybe find some inflation hedges through some of these commodity plays. But it's getting difficult out there, Chhad. So where do you weigh in on that?
Absolutely. And the demand side, I think we've talked about this in the past, is ultimately demand is weakening, and you're seeing it more so, I would say, in industrial activity. Certainly, even consumers' appetite to pay ever higher prices for gasoline is ebbing. And I think this is natural at this point in the economic cycle. And so, commodities to us have been certainly at risk for months, and we know there's some downside there. Energy, the one thing that's keeping us, I'd say, closer, to a little bit of a neutral weight, is still the geopolitical risk, right? As we get into the winter heating season, just the chance that energy becomes weaponized once again in the Russia-Ukraine conflict is certainly still there. But absent the geopolitical element, it is natural for commodity prices to begin to roll over as demand in the economy begins to soften.
Yeah, we'll watch the geopolitical risks. We are out of time, but I got to squeeze one because you talked about defensive, like a defensive mindset. Any ideas, sort of suggestions on what you do to be defensive in this market?
Yeah, sure. And I mean, it really gets back to the fact that, and it's beginning to play out today, that some of these moves that we saw over the last couple of weeks, a little bit overdone in terms of the narrative. So it's a great opportunity to begin to, further get your portfolio into more defensive characteristics, so more defensive sectors over the more cyclical exposures. We still like some high quality components of the growth market. So, you mentioned a lot of technology stocks off the top. Some are strong, resilient earners throughout the cycle. So, some of those gains I think will be sticky. Others that are more pandemic plays, we're certainly less a fan of. And ultimately, we're de-risking even our equity exposure in some of this strength that we've seen.
Okay, Chad.